What is up, guys? Mike Wang here, back with my first stock analysis. In this video, I'll be talking about Airbnb's upcoming IPO and everything you need to know as an investor. So for those of you who live under a cave, Airbnb is an online rental marketplace for lodging, homestays, and tourism experiences. The company does not own any real estate listings, but offers a platform through which people can take part in the sharing economy. Airbnb announced it's filing for an initial public offering in August. In this analysis, we'll be going over everything investors need to know about the IPO and my own insight on whether this is a golden opportunity. Most of the information provided in this video is based on the S1 Airbnb submitted to the SEC. Just a disclaimer, this is not financial advice. This is meant for educational and entertainment purposes only. The company will be listed on the Nasdaq exchange under the ticker ABNB. The IPO is possibly taking place in December of 2020, but nothing has been confirmed yet. The specific price per share is also yet to be officially announced. So let's first go over to the business model. Airbnb connects hosts who are willing to provide rooms with guests. Airbnb profits from charging a service fee to both the host and the guest. Here we can see an example of how that works. The host sets a price of $100 per night, and Airbnb takes $3 as fees. The guest pays a total of $116, in which $100 covers the cost of the lodge, $4 for taxes, and $12 for Airbnb's fees. So Airbnb takes $15 in total service fees from both the host and the guest. While the company initially started off as hosts providing bedrooms, it has managed to find and expand on different types of lodges. So now you can even find a treehouse or a glamping spot to spend the night at. Airbnb is also well known for its systematic operations. They have a unique guest-host review system, rules regarding cancellations and deposits, and is oriented and focused on building a community. So let's take a look at some of Airbnb's competitors. None of them are nearly as big as Airbnb, but it's important to consider the growing competitiveness within the booking market. Airbnb's counterparts include companies like Expedia Group and Booking Holdings. Unlike Airbnb, both Expedia Group and Booking Holdings have been reporting solid earnings as their operating profits increased year over year. However, to be fair, these companies also fell victim to the COVID pandemic. Now, before we move on to the financials of the company, please smash the like button to this video if you're finding it helpful. It really helps the YouTube algorithm and growth motivates me to make more of these videos. Also, there will be some financial terms that you might not be too familiar with, but I will be explaining them in future videos, so also make sure to subscribe. So moving on to the financials. Due to the pandemic, the company's revenue and profitability plummeted in 2020. In the second quarter of 2020, the revenue was at $350 million, which is a 67% decrease compared to that of the second quarter of 2019, which recorded a quarterly revenue of over $1 billion. These numbers are less than half of the reported revenue for the first quarter of 2020, which marked $842 million. The fact that the company is not profitable yet is also quite fatal. I personally like to invest in companies that demonstrate a year-over-year growth in revenue and earnings because their strong financials reflect the sustainability of the business over the long term. In 2017 and 2018, there was a lot of hype around the company as they showed positive numbers for their EBITDA, which is earnings before interest, taxes, depreciation, and amortization. But the company has been reporting inconsistent earnings ever since, and their future earnings remain a mystery. As of September 30 of 2020, the company has $2.6 billion in cash, which is more than the numbers reported for cash and cash equivalents in 2019 and 2018. Nonetheless, this is way below their short-term net liabilities of $4.38 billion, which is considered a warning sign in terms of financial stability. Additionally, they have $1.8 billion in long-term debt that they need to pay back as well. In April, it was reported that the company's valuation dropped from $31 billion to $18 billion. It was valued at a $31 billion company during its Series F valuation. Taking all of this into consideration, we can make an educated guess that Airbnb is trying to seek funds through this IPO. It has already undergone its Series F investments and is a unicorn company, which is a private company with a valuation of over $1 billion, making it difficult to receive any further meaningful investments. Airbnb is also part of an industry that was arguably most heavily affected by the pandemic. They had a net 4.1 million cancellations in March when fear regarding the pandemic peaked. This is important because the pandemic has fundamentally changed the way we live. Even while the world goes through waves in numbers of confirmed cases, people prefer staycations at hotels as opposed to Airbnbs. Preferences of staying in closed, private areas such as hotel rooms have become the new norm. Instead of traveling around the world, meeting people within Airbnb's community, people prefer to spend their money relaxing at luxury hotels. As a result, Airbnb's goal of creating a community of hosts and guests has faced a huge obstacle. Whether people want to travel via Airbnb even after the pandemic is solved still remains extremely murky, as clear solutions to the current situation are yet to be proposed. Unfortunately, unlike other large tech companies, Airbnb lacks the cash to endure a long phase of hardship. As such, they laid off over 1,900 employees to cut costs. Moving on to other cases of firms, we have seen other companies within the sphere of the sharing economy take part in IPOs that have failed miserably. Companies such as Uber Technologies and Lyft are prime examples. These companies were provided multiples way above their actual value, and their stock prices eventually fell way below the IPO price. Uber had their IPO at $45 a share, and Lyft's IPO price was $72 a share. Uber has been underwater for weeks, and its stock currently trades at $50, while Lyft is still underwater, trading at $39 a share, way below the IPO price. For another example, we can look at WeWork. This company was once valued at $47 billion, but failed its IPO due to massive debt and shaky corporate structures, and is now valued at $2.9 billion. WeWork is still considered a prime example of what happens when a company is valued way below its actual enterprise value. Given past cases of other tech companies within the realm of the sharing economy having undergone failed IPOs due to overvalued multiples, it's important to consider why Airbnb might be exempt from this case. In summary, while Airbnb's listing is arguably the most important IPO of 2020, investors need to consider all possible factors before participating in the IPO. Its growing number of users suggests that the business is on the right track over the long run, but financials suggest that the company is in for a bumpy ride for the short term. Airbnb also faces serious external risk that the company has no control over. As this risk extends throughout time, the more damaging it is to the fundamentals of the business, thus providing room for investors to reconsider the proper valuation of the company. In my opinion, given that the company goes public at a $30 billion valuation, I think we'd see prices drop sharply after the IPO. It's important that we wait to see what the price per stock for the IPO will be set as. Also, if I were to invest in this company for the long term, I'd also look for further growth factors. We've seen from previous cases of platform businesses that owning a platform itself does not indicate dominance in the market. In the case of OTT markets, it didn't take long to realize that the original content was more important than the platform itself. So I'd want to see innovation in terms of the business model for Airbnb in the coming years as well. Overall, my take on the stock is neutral. This is a unicorn that is widely known by the general public, but there is bad news both internally and externally that's too bad to ignore. If anything, I'd wait until the stock actually gets listed and add it to my portfolio depending on the market's reaction and signs we see of the world recovering from the pandemic. If you made it to the end of this video, I really appreciate it. I hope this was helpful, and even if you had a hard time understanding everything I said, no worries. I'll be making more videos on the basics of how to read financials and what to look for as an investor. If you liked this video and found it to be helpful, please don't forget to drop a like, make sure to subscribe for future videos, and I'll see you guys in the next one.